Should you invest in actively managed funds or should you invest in index funds? And what are ETFs? Should you invest in ETFs? I think the number of times I've been asked this question over the last 4 to 5 years is more than any other question that I've been asked in the last 15 to 20 years since I've been doing financial advisory. So today I thought I'll just clarify a few of the doubts, and I actually told a few of my clients I'm going to share this with them. So first, understand the difference between what is an index fund and what is an actively managed mutual fund and what is an ETF. An actively managed fund is a fund where the fund manager actively adds and removes stocks based on market environment. An index fund, on the other hand, as the name suggests, is a fund which replicates the performance of an index like the Nifty 50 or the Nifty Next 50. So it would just copy the performance of whatever that index does. An ETF, on the other hand, could be an actively managed fund or it could be an index fund. All it means is that whatever the fund is listed on the stock exchange. So basically, it's like buying and selling a stock. The settlement cycle is just like a stock. So you buy today and it will come to your demat account by the end of the day. You sell today and the money will come back to your account tomorrow. Typically, the expense ratio is lowest for index funds, slightly higher for ETFs and much higher for actively managed mutual funds. So which one should you choose and what considerations should you give? I have these 3 rules of selecting these for my clients based on the kind of clients they are. So let's discuss these rules. So rule number 1, I think as a first rule, you have to forget that you ever heard that actively managed funds, most of them or a majority of them underperform their index. This is not true. I want you to have a look at these large cap actively managed mutual funds. If you look at their performance, they've delivered on average anywhere between 22 to about 25% return on a CAGR basis in the past 5 years. If you compare this with the Nifty's 5-year CAGR is around 12.5%. Now, obviously, when you look at all the actively managed funds across board managed by any fund manager, it's true that around 60 to 70% of them may be underperforming their index. But the top 10 funds, and these top 10 funds you will notice will always remain the same. Yes, Nippon, which is the top ranked fund, would probably become the 7th, and the 7th ranked fund would become the 1st. But the top 10 funds broadly remain the same. So if you keep your universe within those top 10 actively managed funds, chances are that in an emerging economy like India, they will continue to outperform their index. And that's just been my experience. So the point I'm trying to make is that when you look at things from a 3-year, 5-year or 10-year perspective, which is at least as much as you should stay invested in mutual funds or keep running your SIPs for, you will notice that good, better performing top 10, top 20 actively managed funds do outperform their indices. In fact, consider this stat. In 2024, if you look at all the mutual funds in India, 70% of large cap and mutual funds registered with SEBI did outperform their indices. If you look at just the large cap and mid cap funds, 78% of actively managed funds outperform the indices. So it's a complete myth that most actively managed funds do not outperform their benchmark index. So just forget that. Rule number 2, and this is, I think, extremely important. Whenever you choose a style of investing, if you've selected on a particular index or a particular fund or a particular ETF, just stay the course. I think the silliest thing to do is to keep switching between actively managed funds and passively managed funds from time to time. The reason is that from time to time, one kind of funds outperform the others. As a general rule, when the markets are really bullish, really buoyant, when there's a lot of FII money flowing into India, you will notice that index funds will outperform actively managed funds in general. And the reason is, it's very obvious. When FII money is coming in, when institutional money, hedge fund money, mutual fund money is coming in, typically FIIs, hedge funds, they invest in frontline stocks and they buy indices like the Nifty 50, the Bank Nifty, Nifty Pharma, Nifty Technology. So frontline indices and frontline stocks outperform the broader thematic universe from which these indices are constructed. But when there is a recovery going on in the market after a period of slowdown, actively managed funds far outperform the index funds. So, if you keep switching every 2-3 years, looking at what's doing better this year or the last 2-3 years, over a longer period, you'll underperform both. So, stick to one style of investing in whatever fund you choose. Give it 3 to 4 to 5 years. In fact, in my opinion, 7 years is the mark at which you can say, yeah, this is a good comparison to look at. And my third rule for selecting active versus passive funds. If you're selecting index funds or ETFs, I think what you should look for is the fund which has the least expense ratio. Typically index funds and ETFs will have expense ratios ranging from 0.10 to 0.55%. But if you're buying a Nifty 50 or a Sensex 30 or a Nifty 500 kind of fund, why not choose that with the fund house which has the least expense? Because if you are replicating the performance of an index, how much tracking error could there be? So ideally, when it comes to index investing or ETFs, your focus should be choosing the fund with the least expense. On the other hand, when you're selecting a fund which has an active management style, a mutual fund, look for past performance, look for the current allocation, because these things are important. If you ask me, if I had to make a portfolio for a client, then based on a lot of his goals and based on a lot of what he wants to achieve with his portfolio, I will have a mix of both. So, obviously I can't give one size fit all kind of allocation, but let's say if there's someone who's 40, 45, 50 years old and who's looking to invest for 10, 15 years and he wants to hold some index funds as well, which is copying an index style, I would actually split his investment between 40% in large caps, 30% in mid caps, and 30% in small caps. And here again, the 40% of large caps that I invest in, that's where I tend to choose a lot of index funds and ETFs. And I wouldn't choose something like a Sensex 30 because that's really narrow, but something like a Nifty 50 or a Nifty 100, the top 100 fund for the large caps. For the mid caps, again, I'll choose an actively managed funds. And the reason is, I've talked about it often, for mid caps and small caps, that's where the true potential of a fund manager is tested, where he can actually buy stocks which do not form part of the index today, but will possibly be part of the index in future. And that's where the real alpha is created. That's where you're paying that extra expense for. And it's related to the point I've often made that when you're looking to buy a small cap actively managed fund, look for a fund which has, even if it has a higher expense, it has a small size. The assets under management are less than something like 3,500 crore. And the reason is that, if it's a very large small cap fund, it would not be able to buy pure small cap companies. Nippon large cap, for instance, it's a 60,000 crore AUM fund. One of the stocks it owns is RateGain Technologies, where it has about 0.4% of its holding. Now, 0.4% holding of a 60,000 crore is something like 240 crores. And RateGain Technologies has a market cap of about 6,000 crores. So if they have to unwind this position, or if they have to buy stocks with market cap of less than RateGain Technologies, it'll be difficult. So, these are the things that you should consider. Again, if you ask me, I prefer to choose actively managed funds for small caps and mid caps because I'm happy to hold stocks which are possibly not as liquid as large caps when I'm trying to create alpha with my small caps and mid caps. And always keep in mind, if you have a portfolio of stocks of your own, then basically what you have is an actively managed fund. Because a stock portfolio of your own is as good as a portfolio manager holding stocks and trying to beat its index. So that's my view on active versus passive versus ETFs. And as I always say, there's no harm in holding all three of these.